Yes, Paul. Well, first of all, I think when you're driving down that New Jersey Turnpike, when John is, I think by the end of this year, you're going to be paying $2 a handle for gasoline versus $3.80 right now.
Yep.
It's a typical cycle. I'll be publishing that on Monday when we come back. It's a normal cycle, but the key thing about crude oil is we're learning the lessons of elasticity. And it just reiterated that major trend in the world of the Western Hemisphere becoming the price maker status. Now you're seeing a lot of the professionals like Morgan Stanley and Goldman Sachs coming down their estimates, but they're realizing what happened is that spike in prices is now increasing that supply, decreasing demand, and adding to that process of technology, hurting both sides of supply and demand of crude oil. So I guess we're not priced for a lot of risk this weekend, even if something flares up in the Gulf. But I think crude oil is going to be heading down on the year with a lot of other commodities have already done that. And that means below $57 a barrel. Right now we're 67.
Well, as someone was observing to us yesterday, Paul, the ceasefire seems to be intact when the markets are closed. And when, when the markets are open. When the markets are closed is when we get these little skirmishes that somehow settle by the time the trading week begins again. So, Mike McGlone, with oil prices, kind of having come down, made the round trip from where they were before the start of the war, the U.S. is in its own special position because we're a net oil exporter. But what about countries that import their oil? How are they responding? How are they reacting? How are they positioning themselves? And how do you think about the price of oil as they try to take advantage of this downdraft in prices?
Well, Scarlett, I'm glad you went there. Consensus is they're all going to be building up their reserves. That's why I find it kind of silly when we talk about our reserve. We're a net exporter. We just don't really need it anymore like we did in the past. They'll be doing that. So there'll be some of a bid below, but I think they'll get lower prices to do that. Remember what's happened. We had drill at will. Mr. Trump's mantra was kind of the U.S. Now it's gone global. We can add Iran to that, Iraq, UAE, Venezuela. The whole world's going to get plenty of oil. It's just a question of the key theme I'm worried about now for what typically makes oil make bottoms is now for oil to just stay stable, the U.S. stock market has to stay up. If it drops down for a typical midterm election as we head to the second half of this year, then instead of going down to 57 or 55, it's going to go down to 40, which is the normal cycle. Remember, this is very similar to 2008. We just didn't make as high as a high, but big difference in 2008 when it went to 147 and down to 40 is the U.S. was a net importer and the stock market actually went down later in the year. So this second half of the year is going to be very unique for all commodities. And if stocks go down, we'll probably see pretty severe deflation in commodities.
On your global commodities dashboard, Mike, what are some of the key issues you're talking to clients about these days?
Well, the key theme so far, Paul, is pump then dump. It started at the beginning of the year with Bitcoin and U.S. natural gas, and now it includes gold, silver, platinum, palladium, iron ore, and corn. The key ones that matter now, copper might be next, and crude oil might be next. Just normal supply and demand will get crude oil probably down in the year. But copper's main risk is if the stock market goes down, because it's a complete sock puppet to the stock market at this moment. It only goes up when stocks go up, and when stocks go down, it goes down more.
What about gold? How does gold fit into all of this? I mean, gold had its moment at the start of the year, and since then, it's been kind of meh.
But Scarlett, you nailed it. Those of us that Paul reminds have been bullish gold forever. We had the best year last year in history and an environment without inflation. That year was just phenomenal, and you're supposed to typically when that happens, it puts in peaks for years. So I think gold's going to knock around a range. It could get to 5,000, it could get to 3,000, but knock out around in a range for the next who knows how long, similar to what crude oil's done for the last 20 years.
All right, Mike. Tom from the Upper East Side writes in and asks, what about Bitcoin? We got below 60,000, traded as low as 57,000. Now we're back above 61. How does this thing play out?
BitDog is a pretty severe bear market that faces massive supply surpluses in all the cryptocurrencies. I look at my Bloomberg terminal, and if you put on the CRYP, there's hundreds of cryptocurrencies and all highly correlated. So we have to flush those out. We're in the process of doing that. And if the stock market goes down, it's going to go down a lot more. And I look over at the GLCO page on the Bloomberg terminal. It only has 20 or so commodities. That's the difference. There's an unlimited supply of these cryptocurrencies. We're flushing them out. The key theme is the mania is over.
So I guess I don't even need to ask about the altcoins, the things that aren't Bitcoin but have coin at the end of their names.
Well, we could talk about Dogecoin. I love Dogecoin. It's number 9. It's worth about $11 billion right now. I really started beating on it 2024 when it was around $60 billion, pointing out it was kind of the same value of BNY Mellon, yet BNY Mellon had $19 billion of revenue. So we need to flush out all these excesses. I think people are getting it, and it's just a matter of time we kind of purge it all. Once we purge it all, we'll find the bottom. So I think Bitcoin's next key support target is around 50,000. And if the stock market goes down in the end of the year, it might head towards 10,000.